Share of ITC Limited surged nearly 17% in the March, the most in the 16-month, even as its peer dropped on fear of the margin pressure due to rising input cost. The stock has been an underperformer for the past few years due to stagnant financial ESG concern and exposure to COVID. Peers such as Godrej Consumer lost 8% in the March, Nestle India dropped 3%, Hindustan Unilever declined 8%, Dabur India 7.6%, while Marico fell 5.4%. Godrej Consumer, Nestle India and Hindustan Unilever have dropped for the third consecutive month, while Dabur India declined for the fourth month. Marico fell for the fifth month. Many FMCG stocks are under pressure due to an increase in input prices and amid rising crude and global commodity rates and global supply chain disruption during COVID, as well as in the Russia-Ukraine war. The firms are also facing lower demand due to increasing prices, said Vinit Bollinger, head of research with Securities. However, analysts expect ITC to be least affected by the rural slowdown, as in portfolio comprise mainly foods. The company offers the best inflation hedge at its core business is an completely immune to inflation risk with volume growth back in the cigarette market and tailwinds elsewhere. ITC may offer earnings surprise in financial 23. Analysts added, ITC is one of the largest consumer company in the India, with the business expanding categories such as cigarette, hotel, paper, and agri-commodities. Its branded foods divisions with products such as staples, confectioneries, noodles, snacks, and biscuits is performing well and gaining strong market share across many categories. In the cigarette business, analysts say legal cigarette player gainer market share from illegal player. Almost 1/4 of the market, as no tax hike was announced for the second consecutive year. ITC's agri-commodity business are likely to be benefit from wheat export because of Ukraine crisis. Analysts says Russia and Ukraine account for 30% of global export. If the Indian wheat crop is good, regulators have a conductive policy and India food inflation does not become a big challenge. The firm's hotel sector is likely to see strong recovery in fiscal year 2030 after continued falling COVID cases, and recently India stressed international flight. According to Omkar Mistry, analysis with the choice broking, faster recovery in hotel business is expected given the vaccination drives and improving economic indicators. IT's paper business is likely to benefit after reopening of offices, educational institutions, and courts. This has led to recognition of the demand sales volumes coupled with higher realization. This was despite as a sharp increase in major input cost in the recent period. Analysis added, although gross margins in the ITC's FMCG sector are likely to remain under pressure or cost optimization and price hikes will help. Considering these factors and a dividend yield of 4 to 3% brokerage firm Edelweiss Securities has maintained a buy rating for the stock. Of the 36 brokers tracking the ITC stock on Bloomberg, 27 have recommended a buy rating, 7 have hold on the stock, and 1 has sell rating. We expect the volume in the cigarette to revive at the CAGR of 5% during financial year 22 to 24 as against a CAGR of minus 1% during financial 11 to 21. FMCG's EBITDA margin to scale up to the higher single digit and the hotel paperboard and agri commodities business to revive. This will lead an earnings CAGR of the 12% in the financial 22 to 24 against a mere 7% in the last 5 years, said Edelweiss Wealth Research in note. The brokerage firm has given a target price of 450 rupees a share up to 80% from the current market price.